Do you know what 870 pages of congressional tax law looks like? It looks like one big, beautiful mess. Back on July 4th, Congress passed the One Big Beautiful Act, an economic package that touches everything from taxes to Social Security to estate planning. So if you're retired or planning to retire in the next 5 to 10 years, this bill matters a lot. Hi, I'm David Caviness, Certified Financial Planner, and today I'm breaking down the 5 things retirees need to know about the One Big Beautiful Bill, and more importantly, what they mean for your portfolio and your long-term plan. So let's get into it. Number 1, tax cuts extended plus new senior bonus deduction equals strategic withdrawal opportunities. The tax brackets from the 2017 Tax Cuts and Jobs Acts have been extended indefinitely. But here's where it gets a little bit interesting. There's a brand new senior bonus deduction of $6,000 per person if you're age 65 or older. It applies whether you itemize or take the standard deduction. Combined with the existing age-based deductions, a retired couple could now deduct up to $46,700 from their taxable income in 2025. So what does this mean for your portfolio? It means the next 4 years offer a window of opportunity to convert IRA dollars to Roth at lower tax brackets, harvest long-term capital gains at potentially 0%, and smooth out income across tax years while deductions are higher. Second thing, Social Security still taxed, but income coordination matters more than ever. Despite the political talk, Social Security is still taxable using the same 40-year-old formula that hasn't been adjusted for inflation. So depending on your income, up to 85% of your benefits could be taxable. So what does this mean for your portfolio? It means income coordination is everything. If you're drawing from pre-tax accounts like IRAs or taking capital gains from a brokerage account, it could unintentionally increase your modified adjusted gross income, causing more of your Social Security to be taxed and possibly raising your Medicare premiums. Number 3, the SALT deduction cap raised equals a temporary tax planning opportunity. The state and local tax, or SALT, deduction cap has been temporarily increased from $10,000 to $40,000 starting this year in 2025. It applies if your income is below $500,000 and the benefit phases out rapidly above that. This increase is set to expire in 2029. So what does this mean for your portfolio? It creates a window to increase deductions and offset taxable portfolio income, especially helpful in years where you're realizing capital gains or doing Roth conversions. Number 4, still no HSA contributions on Medicare, but spouse planning is key. So if you're on Medicare, you're still locked out of contributing to an HSA. But if your spouse is still working and covered by a high deductible health plan, they can still make the full family HSA contribution, even if you're the one incurring medical expenses. So again, what does this mean for your financial plan? You still have an opportunity to grow tax-free dollars that can be used later for healthcare, reducing pressure on your taxable or IRA withdrawals. And number 5, estate and charitable changes equals time to rethink your legacy plan. Starting next year in 2026, the federal estate tax exemption increases to $15 million per person or $30 million for a couple. Also starting in 2026, if you take the standard deduction, you can deduct up to $2,000 in charitable gifts. If you itemize, your giving must exceed 0.5% of your AGI to count. So again, what does this mean for your portfolio? It's time to review your charitable strategies, gifting plans, and how your accounts are positioned for wealth transfer. The tools haven't changed, but the thresholds have. Now, other provisions you might care about, here are a few extras that were tucked into the bill that could still impact your plan. Car loan interest deduction, up to $10,000 in deductible interest on new personal use cars, those assembled here in the U.S., available through 2028, and phased out above $250,000 income for those married filing joint. You hear no federal tax on tips and overtime. That excludes up to $25,000 of each from federal income tax. Payroll and state taxes still apply though. Phased out again for high earners. And Trump accounts. These are new tax-deferred accounts for kids born between 2025 and 2028. Initial $1,000 federal contribution. Gains taxed as ordinary income, not capital gains. And pass-through entity deduction for business owners who exceed the SALT deduction. State and local taxes may still be deductible at the business level. So just my final thoughts here is that, Congress has changed the rules again, and like always, some of the changes help, some don't, and some, they're just flat out confusing. But what you do next is what matters the most. If you're in or near retirement, your decisions, how and when you take income, what deductions you use, when you claim Social Security, how you manage your modified adjusted gross income, they all work together. And if your plan hasn't been updated to reflect these changes, let's fix that. And encourage you to visit my website at CavinessWealth.com, where you can learn more about me, you can schedule a call, and we can have an initial conversation. We'll help you stay ahead of the curve, reduce surprises, and build a strategy that works, no matter how long or beautiful the next bill is. Thanks for watching. I'm David Caviness, Certified Financial Planner. Let's make smart money moves together.